October 1907. Wall Street is dying. In the streets of New York, what began as a silent crash has become a deafening roar of panic. Families line up in the cold, clutching what remains of their savings, hoping the doors of their banks will open before the money inside disappears forever. Trust is collapsing, liquidity is vanishing, and for the first time in its history, the United States government stands powerless to stop it. There are moments in the history of finance when the entire architecture of modern civilization balances on the decisions of a single man. Not an elected official, not a president, not a committee of experts armed with models and emergency protocols, but one private citizen operating from a quiet library filled with the echoes of older empires, whose personal word carries more weight than the combined reserves of the United States Treasury. October 1907 was one of those moments. To understand how a nation could arrive at such a precipice, you must first see the world as it was on the eve of the panic, an America intoxicated by its own expansion, railroads threading through mountains, steel mills burning through the night, mines carving deep into the earth in pursuit of growth without limit. And beneath it all, a financial system so vast, so interconnected, and so fragile that a single failure in a Manhattan trust company could ripple outward, closing banks, freezing credit, and casting hundreds of thousands into uncertainty. There was no central bank, no deposit insurance, no lender of last resort, only confidence. And when that confidence broke, the system began to collapse under its own weight. What followed, in the span of just 3 weeks, would not only halt that collapse, but would reshape the foundations of modern finance itself, laying the groundwork for a new kind of institution designed to stand where none had stood before. But that transformation did not begin in Congress or in the Treasury. It began behind closed doors, on a single night, with a single decision and a single man. This is the story of the panic of 1907 and the night the modern financial world was born. And as you settle into this story, into its tension, its shadows, and its consequences, consider the question at its core. Should any one individual ever hold such power over an entire economy? Was he a necessary force or a dangerous precedent? If you find yourself drawn into these hidden chapters of financial history, there is far more waiting for you here. Subscribe and turn on notifications so you never miss an episode of these financial chronicles. And when you're ready, leave your thoughts below. I'll be there, exploring the best of them with you. The reason this story demands your attention now is not merely academic. It is not a relic of a distant, extinguished world. Because in many ways, we are living through its echo. An era of quiet, accumulating strain, of financial systems stretched beyond their visible limits, yet held together by confidence, policy, and the fragile assumption that control still exists. Look closely, and the signs begin to emerge. Over-leveraged institutions balancing on narrowing margins. Shadow banking networks of immense complexity operating just beyond the reach of clear oversight. A commercial real estate market slowly, almost politely disintegrating beneath the surface of reassuring headlines. regional banks carrying unrealized losses so vast they remain largely unspoken. And above it all, a global monetary system under its most profound structural stress since the collapse of Bretton Woods. The institutions designed to prevent another 1907, the central banks, now stand at the center of a different kind of question. Their balance sheets swollen, their interventions extended far beyond their original intent, their credibility no longer absolute. And so the old question returns, quietly, persistently. Who saves the system when the system itself is the problem? The reason this story demands your attention now is not merely academic. It is not a relic of a distant, extinguished world. Because in many ways, we are living through its echo. An era of quiet, accumulating strain, of financial systems stretched beyond their visible limits, yet held together by confidence, policy, and the fragile assumption that control still exists. Look closely, and the signs begin to emerge. Over-leveraged institutions balancing on narrowing margins, shadow banking networks of immense complexity operating just beyond the reach of clear oversight, a commercial real estate market slowly, almost politely disintegrating beneath the surface of reassuring headlines, regional banks carrying unrealized losses so vast they remain largely unspoken, and above it all, a global monetary system under its most profound structural stress since the collapse of Bretton Woods. The institutions designed to prevent another 1907, the central banks, now stand at the center of a different kind of question. Their balance sheets swollen, their interventions extended far beyond their original intent, their credibility no longer absolute. And so the old question returns, quietly, persistently. Who saves the system when the system itself is the problem? The Panic of 1907 is not only a story of collapse, it is a story of innovation outpacing understanding, of financial instruments evolving faster than the frameworks meant to contain them. In 1907, that instrument had a name, the trust company, a new kind of financial intermediary, lightly regulated, aggressively expanding, offering higher returns than traditional banks while operating with far fewer constraints. To the public, they appeared modern, efficient, safe. But beneath that surface, they carried risks no one fully measured, no one fully understood, until it was too late. If this feels familiar, it should, because a century later, the names changed, but the structure did not. Structured investment vehicles, mortgage-backed securities, off-balance sheet entities. Different language, same function. Mechanisms for generating extraordinary returns in times of stability while quietly concentrating extraordinary risk, waiting for the moment when confidence breaks and the entire structure is forced into the light. The great economic historian Charles Kindleberger once observed that history does not repeat itself with mechanical precision, but it rhymes. And the rhyme between 1907 and our present moment is not subtle. It is deep, it is structural, and it is growing louder. Because what we are about to explore is not simply the anatomy of a past crisis, but a mirror, one that reflects a system we still inhabit, one that may, under the right conditions, begin to fracture in very familiar ways. To understand how the panic of 1907 could erupt with such force, you must step backward, not just to the months before the crisis, but to the decades that made it inevitable. Rewind to the aftermath of the Civil War, when the United States began a transformation so rapid, so violent, and so exhilarating that even those living through it struggled to comprehend its scale. Between 1865 and 1907, America did not simply grow, it accelerated. Railroad tracks stretched outward like veins across a continent, from 35,000 miles at the end of the war to nearly 250,000 by the turn of the century. Distances collapsed, markets fused, a fragmented collection of regional economies became a single integrated machine. Steel rose from nothing into dominance as industrial furnaces burned through the night, turning raw ore into the skeleton of a new civilization. Oil fields surged, electrical grids flickered into existence, communication leapt forward, entire industries were born almost overnight. This was not expansion, it was transformation, and it was financed by debt. Enormous debt, audacious debt, often reckless debt. Beneath the surface of this industrial miracle, a financial system evolved to sustain it, ingenious, adaptive, and deeply fragile. The national banking framework provided structure, but not stability. It was a system full of gaps, blind spots, and silent fault lines, many of which had already been exposed, again and again. In 1873, the system cracked under the weight of railroad speculation, triggering a depression that lingered for years. In 1884, the failure of key financial institutions sent shockwaves through New York, revealing how tightly interwoven balance sheets had become. In 1893, the strain was unbearable. Banks collapsed, businesses failed, unemployment surged, and the nation entered one of the deepest economic crises in its history. Each panic felt different in its details, but beneath them, the pattern was the same. It began with opportunity, a new technology, a new frontier, a genuine expansion of possibility. It moved into optimism, then into speculation, then into excess. Leverage crept in, risk multiplied, prices rose beyond reason, and then something small would break. A failure, a rumor, a shift in confidence so subtle it was almost invisible, and suddenly the entire structure would reverse, collapsing inward with the same momentum that had once driven it upward. Relentless, unforgiving. This cycle would later be formalized into theory, but in this era, it was lived. Yet beneath all of these crises lay a deeper flaw, an absence. In other financial centers, particularly in Britain, there existed a stabilizing force, an institution capable of stepping into moments of panic and doing what private actors could not, providing liquidity, restoring confidence, halting the cascade before it consumed the system. A lender of last resort. The United States had no such mechanism. It had once experimented with central banking and rejected it. Distrust of concentrated financial power ran deep in the American political psyche, and institutions that resembled centralized control had been dismantled one after another. What remained was a system forced to improvise in moments of crisis, to rely not on structure, but on individuals. And among those individuals, one figure had already begun to stand apart. In 1895, when the nation's gold reserves faltered and the stability of the currency itself came into question, a single banker orchestrated a rescue so bold, so precise, that it restored confidence where none remained. It was not a government solution, it was a private intervention, and it worked. From that moment forward, the idea took hold, quietly, almost unconsciously, that in times of extreme danger, there existed a man who could act when no institution could. So when the storm of 1907 began to gather, when the same patterns re-emerged, only larger, more interconnected, more dangerous, the country did what it had learned to do. It turned not to a system, but to a man. And what followed would reveal something both extraordinary and deeply unsettling. That while a single individual could, for a moment, hold the system together through force of will and reputation, no individual, no matter how powerful, could ever be a permanent solution to a structural problem. What you are about to witness is the breaking point of that illusion. The story of the Panic of 1907 does not begin on Wall Street. It begins an entire continent away. San Francisco, April 18th, 1906, 5:12 in the morning. The ground trembles, then convulses. Buildings collapse in seconds, gas lines rupture, fires ignite, and for 3 days the city burns, consuming streets, homes, and fortunes alike. By the time the flames subside, thousands are dead, tens of thousands are displaced, and an entire economic center has been reduced to ash. At first glance, this catastrophe appears distant from the financial drama that would unfold in New York the following year. But beneath the surface, the connection is already forming, invisible, relentless, because the destruction of San Francisco did not end with fire. It set gold in motion. The global monetary system of the early 20th century rested on a simple and unforgiving foundation: gold. Every dollar, every pound, every major currency was ultimately anchored to physical reserves. Money could expand only as far as gold allowed, and when gold moved, the entire system shifted with it. The insurance companies responsible for rebuilding San Francisco were largely British. Their obligations, however, were denominated in American dollars. To pay those claims, they needed gold. And so, quietly at first, then in increasing volume, gold began to flow from London to New York. A drain, a tightening, a silent extraction of liquidity from one financial center to stabilize another. In London, the effect was immediate. The Bank of England, watching its reserves diminish, responded in only one way it could: by raising interest rates, making capital more expensive, pulling gold back toward itself. But capital is never still. As rates rose in London, money began to leave New York. Credit tightened, not abruptly, but steadily, like a screw turning. Month after month, through 1906 into 1907, the pressure built. At the same time, the American economy, so recently intoxicated by expansion, began to show signs of strain. The railroad boom, once the engine of speculative optimism, was faltering under regulatory pressure and narrowing profits. The copper market, stretched thin by speculation, began to waver. And deep within the financial system, the trust companies, those elegant institutions of marble and confidence, held portfolios increasingly exposed to a market that was no longer rising with certainty. They had become something new, something powerful, and something dangerous. The trust company was the shadow banking system of its age. Born as conservative custodians of wealth, they had evolved into aggressive engines of finance. They took deposits, issued loans, underwrote securities, all while operating with fewer constraints than traditional banks. They offered higher returns, greater flexibility, and to the public, greater promise. Their lobbies were grand, their directors were prestigious, their growth was extraordinary. But beneath that polished surface lay risk, concentrated, interconnected, and deeply dependent on a single, fragile assumption: that asset prices would continue to rise. Much of their capital was tied to the stock market, not directly, but through the mechanism of call money, short-term loans extended overnight, used by brokers to finance speculative positions, loans that could be recalled at any moment. In good times, this system fueled the ascent. In bad times, it accelerated the fall. Because when confidence wavered, those same loans would be called back, positions would be liquidated, prices would drop, collateral would weaken, and the cycle would feed on itself, faster, sharper, more destructive with each turn. Every system like this waits for a spark. In October 1907, that spark arrived, not from a grand institution, not from a government, but from a man. F. Augustus Hines, a copper magnate from Montana, brilliant, ambitious, and dangerously confident. He had built his fortune through ingenuity and relentless aggression, exploiting the complexities of mining law to outmaneuver rivals and emerge extraordinarily wealthy. But wealth was not enough. In New York, Hines sought something greater: control. Together with his associates, he constructed a financial network, banks, trusts, and lending relationships, all intertwined, and set his sights on a bold and perilous objective: to corner the stock of United Copper. The strategy was simple in theory: drive the price upward using borrowed money, force short sellers, those betting against the stock, into a desperate scramble to buy shares at any cost, trigger a cascade of losses, and capture immense profit in the chaos. For a moment, it seemed to work. The price surged, confidence followed, the illusion of control held, and then it broke. Within 48 hours, the entire scheme collapsed. The short sellers found shares Hines could not control. Supply appeared where none was expected, and the price, once soaring above $60, plunged toward $10 with breathtaking speed. The losses were immediate, and they did not remain contained, because every loan secured against that stock, every institution connected to Hines's network, every balance sheet intertwined with his empire, experienced the impact. And in that instant, what had been a speculative failure became something far more dangerous: a fracture spreading through the financial system, searching for its next point of collapse. To understand how the failure of a single speculative scheme could threaten an entire financial system, you must understand the anatomy of contagion. How panic travels, how fear becomes failure. Because in finance, collapse is rarely contained. It does not remain where it begins. It spreads through connections both visible and unseen, carried not only by money, but by something far more fragile: confidence. The first fracture was simple, direct. Heinz's institutions had lent heavily against United Copper stock. When that stock collapsed, losing nearly 80% of its value in mere days, the collateral behind those loans evaporated. What had once appeared secure was suddenly insufficient. Losses emerged, balance sheets weakened, and almost immediately, depositors began to move. At the Mercantile National Bank, the center of Heinz's financial network, whispers turned into action. Depositors arrived, quietly at first, then in growing numbers, demanding their money back. Heinz resigned in an attempt to restore confidence, but the effect was the opposite. Because in a moment of uncertainty, resignation does not signal stability. It signals confirmation. The run accelerated. The second fracture was more subtle and far more dangerous: association. In the financial world of 1907, institutions were bound together not only by transactions, but by reputation. Shared directors, shared borrowers, shared exposure, real or imagined. And in a panic, perception becomes reality. Depositors do not analyze balance sheets. They do not wait for clarity. They ask simpler questions. Which banks are connected? Which names appear together? Which doors might close next? And as those questions spread, asked simultaneously by thousands, each acting in self-preservation, the panic began to move from one institution to another. Not always because of actual losses, but because of perceived proximity to them. And in a system built on fractional reserves, perception alone is enough to destroy even a healthy bank. Because no bank, no matter how sound, can survive if enough depositors demand their money at once. Nowhere was this vulnerability more acute than in the trust companies. They had built their success on a quiet imbalance: short-term promises, long-term commitments, deposits that could be withdrawn at any moment, invested in assets that could not be quickly sold. And behind it all, reserves too thin to withstand sustained pressure. This was the essence of shadow banking, then as now, and it carried within it a fatal flaw. Because when withdrawals begin, institutions must raise cash. To raise cash, they must sell assets. But when many institutions sell at once, prices fall. And falling prices weaken balance sheets further, forcing more sales, triggering more withdrawals. A spiral, self-reinforcing, unforgiving. At the center of this storm stood one institution, not the weakest, but the most visible: the Knickerbocker Trust Company. It was a pillar of the financial landscape, immense deposits, an imposing presence on Fifth Avenue, a board filled with the names of New York's elite. To the public, it symbolized strength, stability, permanence. But in October 1907, its connections became its vulnerability. Its president, Charles Barney, was linked, however distantly, to the same network that surrounded Heinz, and in the charged atmosphere of fear, that was enough. No proof was required, no evidence examined, only association. On the morning of October 22nd, the doors opened, and the line was already there, stretching down the street, silent, patient, terrified. Depositors stepped forward one by one, exchanging trust for cash, and the money began to leave, quickly, relentlessly. Within hours, millions were withdrawn. Inside, reserves diminished. Outside, the line did not shorten, it grew. The New York Clearinghouse, the closest thing the system had to coordination, refused to intervene. Whether from caution or miscalculation remains a matter of history. But the effect was immediate and irreversible. By midday, Knickerbocker could no longer meet the demand. Its doors closed, not gradually, not quietly, but in full view of a watching city. The impact was electric. If Knickerbocker could fail, what else could fail? The panic spread to the Trust Company of America, to the Lincoln Trust, across the financial system. The stock market began to fall. Call money rates, the lifeblood of speculative finance, surged to impossible levels. Credit froze, transactions halted, and the vast machinery of American finance began to seize, not slowly, but all at once. Because what had begun as a single failure had become a system-wide event, a chain reaction, and there was no mechanism in place to stop it.
The mechanisms that produced the panic of 1907 are not relics of a vanished world. They are a blueprint, a pattern that has been repeated, refined, and reassembled across every major financial crisis that followed, adapted to new technologies, new institutions, new language, but never truly changed, because the structure of fragility remains the same. The trust companies of 1907 did not disappear, they evolved. They re-emerged under different names, in different forms, wearing the appearance of innovation. In 2007 and 2008, they took the shape of structured investment vehicles, operating just beyond the regulatory perimeter, performing the functions of banks without the constraints imposed on banks. In another corner of the system, they appeared as money market funds, promising stability, offering liquidity, while quietly relying on underlying assets that could not always deliver either. And more recently, they have taken form in digital exchanges and new financial platforms built on speed, accessibility, and the same ancient promise: higher returns with manageable risk. In good times, these structures thrive. They accumulate capital. They expand rapidly. They reward those who participate early. But beneath that expansion lies a familiar trade: freedom from regulation in exchange for hidden fragility. And when the cycle turns, that fragility does not remain contained. It spreads. The deeper danger, however, lies not only in structure, but in knowledge, or rather, the absence of it. In 1907, depositors could not distinguish between institutions that were insolvent and those that were merely illiquid, and so they treated both the same. They withdrew, they ran, and in doing so, they transformed uncertainty into collapse. Today, the instruments have grown more complex. Balance sheets are layered with derivatives, securities, and exposures that require expertise and time to interpret. But the human response has not changed, because complexity does not eliminate panic, it amplifies it. When uncertainty rises, understanding does not spread fast enough to contain it. Confidence disappears first, clarity arrives later. This pattern has repeated itself with remarkable consistency. Risk accumulates quietly, often in plain sight. Warnings exist, but remain unheeded. Confidence holds until suddenly it does not. And when it breaks quickly, turning what could have been managed into something that must be contained. There is, too, a global dimension, one that mirrors the hidden mechanics of 1907 with unsettling precision. Then it was gold, moving silently across oceans, tightening conditions in one country while loosening them in another. Today, it is capital, faster, vaster, instantaneous. Financial systems are no longer merely connected, they are fused. And at the center of this system stands a new kind of power. Not gold, not private bankers, but central banks whose decisions ripple outward across the entire world. When interest rates rise in one major economy, liquidity tightens everywhere. When policy shifts, capital moves. And when stress emerges, it does not remain local. It transmits across borders, across markets, across systems that are far more interdependent than those of 1907 ever were. And so the echo becomes clear. Regulatory gaps allow risk to gather. Complexity obscures its scale. Confidence sustains the illusion of stability until something shifts, something small, something almost insignificant, and suddenly the entire system must confront what it has become. The panic of 1907 was not an anomaly. It was a revelation, a moment when the underlying mechanics of finance were exposed in their purest form. And what it revealed is still true today. That stability is often an illusion. That complexity is not the same as safety. And that the line between order and collapse is drawn, always, by confidence.
The narrative profile, the gilded arbiter. It is tempting to tell this story as a myth, a single man standing against the storm. J.P. Morgan, immovable, decisive, almost mythological in his presence, holding back the collapse of an entire financial system through sheer force of will. And there is truth in that image. But it is not the whole truth. And to accept it too easily is to miss what really happened. Morgan was, without question, extraordinary. A figure of immense presence, a man whose silence carried weight, whose gaze unsettled even the most powerful men in finance, whose judgments seemed to arrive not through calculation alone, but through something closer to instinct. By 1907, he had become something more than a banker. He was a stabilizing force, an institution. And yet, he was also 70 years old. His health was fading, his energy no longer exhaustible, and perhaps most importantly, he had never truly wanted the role history had assigned to him. He had not sought to become the financial guardian of a nation. He had simply become the only one capable of acting when no system existed to take his place. Because Morgan was not alone. Behind the image of the solitary figure stood a network, dense, interconnected, quietly powerful. What unfolded in October 1907 was not the work of one man, but of an entire financial establishment moving in coordination, bound not by formal authority, but by relationships, trust, and shared interest in preserving the system that sustained them all. At Morgan's side stood men of equal influence, if not equal legend. James Stillman, head of one of the most powerful banks in the country, whose resources formed a critical foundation for the liquidity that would be deployed. George F. Baker, cautious, disciplined, and unwavering, whose judgment helped determine which institutions could be saved and which would be allowed to fail. Together, they formed a kind of inner council, not elected, not official, but decisive. Night after night, they gathered in Morgan's library, a room heavy with history, lined with manuscripts, paintings, artifacts of past civilizations, now serving as the command center for the preservation of a modern one. Behind closed doors, they worked, evaluating balance sheets, weighing risks, calculating how much liquidity each failing institution required, and who among the surviving institutions could provide it. Decisions were made quickly, without public scrutiny, without delay, because delay was something the system could not afford. Around this private core, the other forces began to align. The United States Treasury stepped forward, not as the leader of the rescue, but as its reinforcement. Funds were deposited into the banking system, providing additional liquidity, but perhaps more importantly, signaling that the government was present, that it recognized the danger, that it would not stand entirely aside. Even the presidency played a role, not through intervention, but through restraint. Power in this moment was expressed not by action, but by the decision not to interfere, to allow those closest to the crisis to act without obstruction. And then there was the system itself, adapting under pressure. The New York clearinghouse, which had hesitated at the critical early moment, now reversed course. It began issuing instruments that functioned as emergency currency, a quiet expansion of the money supply, created not through law, but through necessity. Rules in moments like this become flexible because survival demands it. And what emerged almost instinctively was a realization as old as finance itself. In a true crisis, liquidity must be created, or collapse becomes inevitable. What makes this moment so revealing is not simply that the system was saved, but how it was saved. Through improvisation, through coordination among private power, through decisions made in rooms the public would never see. It worked, but it revealed something uncomfortable, something enduring, that beneath the formal structure of finance, there often exists another layer, less visible, less accountable, but no less powerful. And perhaps the most important lesson is this: Morgan did not represent a solution. He represented a substitute, a temporary answer to a permanent problem. because no system can rely indefinitely on the judgment of individuals, no matter how capable, no matter how disciplined, to perform functions that require structure, continuity, and legitimacy. The events of 1907 would prove that such power could exist, but they would also prove that it should not have to.
It is tempting to tell this story as a myth. A single man standing against the storm. J.P. Morgan, immovable, decisive, almost mythological in his presence, holding back the collapse of an entire financial system through sheer force of will. And there is truth in that image, but it is not the whole truth. And to accept it too easily is to miss what really happened. Morgan was, without question, extraordinary. A figure of immense presence, a man whose silence carried weight, whose gaze unsettled even the most powerful men in finance, whose judgments seemed to arrive not through calculation alone, but through something closer to instinct. By 1907, he had become something more than a banker. He was a stabilizing force and human institution. And yet, he was also 70 years old. His health was fading, his energy no longer inexhaustible, and perhaps most importantly, he had never truly wanted the role history had assigned to him. He had not sought to become the financial guardian of a nation. He had simply become the only one capable of acting when no system existed to take his place. Because Morgan was not alone. Behind the image of the solitary figure stood a network, dense, interconnected, quietly powerful. What unfolded in October 1907 was not the work of one man, but of an entire financial establishment moving in coordination, bound not by formal authority, but by relationships, trust, and shared interest in preserving the system that sustained them all. At Morgan's side stood men of equal influence, if not equal legend. James Stillman, head of one of the most powerful banks in the country, whose resources formed a critical foundation for the liquidity that would be deployed. George F. Baker, cautious, disciplined, and unwavering, whose judgment helped determine which institutions could be saved and which would be allowed to fail. Together, they formed a kind of inner council, not elected, not official, but decisive. Night after night, they gathered in Morgan's library, a room heavy with history, lined with manuscripts, paintings, artifacts of past civilizations, now serving as the command center for the preservation of a modern one. Behind closed doors, they worked, evaluating balance sheets, weighing risks, calculating how much liquidity each failing institution required and who among the surviving institutions could provide it. Decisions were made quickly, without public scrutiny, without delay, because delay was something the system could not afford. Around this private core, other forces began to align. The United States Treasury stepped forward, not as the leader of the rescue, but as its reinforcement. Funds were deposited into the banking system, providing additional liquidity, but perhaps more importantly, signaling that the government was present, that it recognized the danger, that it would not stand entirely aside. Even the presidency played a role, not through intervention, but through restraint. Power in this moment was expressed not by action, but by the decision not to interfere, to allow those closest to the crisis
to act without obstruction. And then there was the system itself, adapting under pressure. The New York clearinghouse, which had hesitated at the critical early moment, now reversed course. It began issuing instruments that functioned as emergency currency, a quiet expansion of the money supply, created not through law, but by necessity. Rules in moments like this become flexible, because survival demands it. And what emerged almost instinctively was a realization as old as finance. In a true crisis, liquidity must be created, or collapse becomes inevitable. What makes this moment so revealing is not simply that the system was saved, but how it was saved. Through improvisation, through coordination among private power, through decisions made in rooms the public would never see. It worked, but it revealed something uncomfortable, something enduring, that beneath the formal structure of finance, there often exists another layer, less visible, less accountable, but no less powerful. And perhaps the most important lesson is this: Morgan did not represent a solution. He represented a substitute, a temporary answer to a permanent problem. Because no system can rely indefinitely on the judgment of individuals, no matter how capable, no matter how disciplined, to perform functions that require structure, continuity, and legitimacy. The events of 1907 would prove that such power could exist, but they would also prove that it should not have to.
By the end of the first week, the panic had not subsided. It had evolved. What began as a shock was becoming a system-wide test of endurance. And at the center of it, Morgan and his inner circle worked without pause, not merely moving money, but managing fear. The immediate priority had been clear: stabilize the Trust Company of America. Through a series of coordinated interventions, banks pooling resources, extending liquidity where none remained, the institution was held together. It was not a simple act of rescue, but a delicate orchestration. Because every dollar committed to saving another institution was a dollar not held in reserve for oneself. And in a panic, self-preservation is the instinct that dominates. What Morgan achieved in those moments was not purely financial, it was psychological. He forced a shift from isolation to cooperation, from hoarding to collective survival. Because he understood something fundamental. Any institution that refused to support the system would soon find the system unable to support it. But even as one fire was contained, another ignited, this time at the very heart of the market itself. The brokerage houses of Wall Street, the firms that made trading possible, were running out of cash. Their lifeblood had been call money, overnight loans, flexible, abundant, essential, and now gone. Without it, positions could not be maintained, trades could not be financed, and one by one, firms began to approach the edge of failure. By October 24th, 25 brokerage houses stood on the brink. The president of the stock exchange arrived with a message both simple and devastating. He was considering closing the exchange. To close the exchange was to admit defeat. It would freeze billions in assets, halt the flow of capital, and signal to the world that the American financial system had ceased to function. Morgan's response was immediate, unambiguous.
The exchange must not close. He summoned the bank presidents urgently, and when they arrived, he presented them with a demand that bordered on the impossible. $25 million in 10 minutes. For a moment, silence. The number was staggering, the time frame absurd, the risk immense. But Morgan did not negotiate. He assigned. Moving from one man to the next, he dictated contributions, precise, unavoidable, final. And something remarkable happened. The resistance broke. Commitment replaced hesitation, and within 12 minutes, the full amount had been pledged. The money was delivered, the exchange remained open, and for that moment, the system held. It was, in miniature, the essence of Morgan's power, his ability to impose coordination where none existed, to override individual fear in service of collective survival. But it also revealed the limitation of that power, because it was not institutional, it was personal. It existed because he existed, and it would vanish when he did. But the panic was not finished. It was accelerating. A new threat emerged, one that reached beyond finance and into the real economy. Moore and Schlee, a major brokerage firm, deeply entangled and on the edge of collapse, not through reckless speculation, but through collateral. They held vast quantities of stock in a struggling industrial company, assets that in ordinary times would have carried value. But in a panic, value disappears, buyers vanish, and assets become unsellable. If Moore and Schlee failed, the consequences would not remain contained. Their obligations would cascade outward, pulling other firms down with them, extending the crisis into new territory. Morgan's solution was as bold as it was decisive. He turned not to the financial system, but to industry, arranging for a massive corporation, one he himself had helped build, to acquire the distressed company whose stock underpinned the crisis. In doing so, he transformed illiquid, collapsing collateral into something stable, something saleable, something that could stop the chain reaction. But there was a problem, a legal one. The transaction, under normal circumstances, would almost certainly have been blocked. It violated the spirit, if not the letter, of antitrust law. And so, in the midst of crisis, the decision moved beyond finance into politics. A message was sent to Washington, quietly, urgently. The situation explained, the consequences outlined, and the question posed: would the government intervene or allow it? The answer came not through debate, but through judgment. Permission was given, not formally, not ceremonially, but decisively. Because in that moment, the priority was clear: prevent collapse, even if it meant bending the rules designed to constrain power in ordinary times. And so the transaction proceeded. The immediate threat was removed, and once again, the system stepped back from the edge. But what this phase revealed more than anything else was the speed of escalation, how quickly a crisis could move from one sector to another, from banks to markets to industry to government itself, and how survival in such moments depends not on rigid adherence to rules, but on the willingness to act decisively and without hesitation when the cost of inaction becomes too great.
We live today in a world that was shaped in no small part by what happened in 1907. A world of central banks, of deposit insurance, of emergency lending facilities and carefully constructed safeguards. A world where the memory of past panic has been translated into structure, into systems designed to prevent the collapse of confidence from becoming the collapse of everything else. It is not a perfect system. It never has been. Crises still emerge, fault lines still form, and each new era introduces pressures, political, technological, structural, that no previous generation could fully anticipate. But beneath all of this complexity, the core truth remains unchanged. The greatest danger in any financial system is not debt, not leverage, not even speculation. It is the loss of confidence, that quiet, irreversible moment when belief gives way to doubt, and doubt gives way to action. When everyone at once moves toward the exit, and the system, built for stability, not for simultaneity, begins to fail under the weight of its own design. Against that moment, there is only one defense, not a market, not an individual, but an institution, an entity with the authority to act, the resources to absorb fear, and the credibility to convince the world that the door will remain open no matter how many seek to pass through it. J.P. Morgan did not build such an institution, not in law, not in permanence, but in the autumn of 1907, he became one. For a brief, momentary span of days and nights, he stood where no structure existed, absorbing panic, imposing order, and holding together a system that could not hold itself. And in doing so, he revealed something far greater than his own power. He revealed what was missing. The institutions that followed, imperfect, evolving, sometimes failing, were built in the shadow of that realization. They were not designed to eliminate crisis. That has never been possible. They were designed to endure it. And so the legacy of 1907 is not merely the story of a panic, or of a man, or even of a rescue. It is the story of a lesson, one written in urgency, in fear, in consequence. A lesson that continues to shape the world we inhabit. Because somewhere, at the edge of every financial system, there is always a door. And in moments of calm, it stands unnoticed. But in moments of panic, it becomes everything. The question, the only question that has ever truly mattered, is this. When the crowd begins to move, when confidence begins to fracture, when the system is tested beyond its limits, who or what will be standing there? And will it be enough?